Option Alpha. So we've got a really cool little case study that I want to go through, and we're going to be looking at the results of three different back tests that we did in IWM, and specifically, we're only looking at the impact of profit targets, taking those profit targets and adjusting them from 25% to 50% to 75%, and then see how it impacted the strategy. So everything else was exactly the same in this particular example that we're going to be going through. The only thing that we adjusted here was profit targets, which is actually very fascinating. So just really quick, if you don't skip ahead, don't look ahead here really quick, but if you just want to add in the chat real quick or in the comments, like what profit target do you think would have created the most successful back test using all historical data for IWM? Is it 25%, 50%, or 75%? So we'd be closing the position once the premium declined by that amount. So if we took in $1 of premium, and then we had a stop loss or a profit target at 25%, once the value of that iron condor went down from $1 to 75 cents, we would take that position off. At 50%, we'd have to wait for the position to go down in value from $1 to 50, right? And so on and so on. So that's really what we're trying to do here. And again, just trying to figure out if we should be taking positions off earlier potentially, or should we be letting positions hold on a little bit longer? This is just one little case study, so this is by no means the end all be all on this discussion, but I thought it was an interesting one. I want to share with you guys so you guys can take a look at it and draw your own conclusions, adjust your own strategies, however you want to go moving forward. Okay, so here's what we're going to do. We're going to go ahead and just flip over here, and we're going to just be looking at this one in total. So can you guys see this really quick for those of you who are in here? Okay, great. So here's the deal for this back test. So we actually set up three different back tests, and we're just displaying them and showing them basically side by side, one on top of another. We used all the historical data that we had for IWM in this case, and you can choose any of the other positions or tickers that you want to trade, obviously. But in this case, we set up a very specific set of criteria for this back test, and it's almost identical across the board. So don't skip ahead and look to all the return metrics and stuff like that. But you can see that the tests are pretty similar. So test 1, A, B, and C, they're all very similar, but they have one slight distinction or difference in them. So here's what we're going to do. We're going to look at the first one here. This is test number A that we ran. This is the first back test that we ran, and then we just kind of grouped them all together inside of the back tester. We were looking at just a portfolio size, starting size of $25,000. 10% of our portfolio was allocated to weekly positions. So we were trying to get into a position every week if possible. That means that we could have some overlapping positions in some cases. And then the other thing is we were limiting the back test, or the bot in this case, to 10 positions at a time. So basically, we didn't want any more than 10 positions. And because we were doing very short duration trades, these were very short, you'll see here in a second, but about 10 days out from expiration or around there, you really didn't need to have a lot of overlapping positions, okay? So if we go down to the position details here, again, just like forget about the left-hand side here. Don't cheat. Don't look on the left-hand side here, okay? You go down a little bit further, and you can see that we were testing an iron condor strategy. The expiration that we were targeting was around 10 days. So this means that we were targeting roughly 10 days to expiration. Sometimes it could have entered a position, 7 days. Sometimes it could have entered a position 11 days. It did not have to be exactly 10 days, but the end result here is that those positions were pretty short duration positions. So you really weren't holding these positions long. The goal of this particular case study and this thought process around it was that you're frequently readjusting the position, right? So you put a position on, then the market moves, then you rip that position off, you put another one on, another one, et cetera, okay? The other thing is we did deltas really far out, okay? So this was actually kind of cool. And I realize I'm not in here. Oh, there I am. Hey, what's up? So we did deltas super far out. So you'll notice right up here that we did the short delta at 15. That means that the short strike of our iron condor is at a 15 delta, which is pretty far out. I mean, that's you're getting pretty far out on the wings for that short strike delta, right? Really, you're targeting positions that, and with the reality is with a 15 delta on both sides, you're probably somewhere around a 70-ish% probability of success with just your initial position that you're putting on, right? And then the long strikes, you'll notice right up above here too, the long strikes were set at a 5 delta. So I said we're going out even further, right, for those long strikes and trying to buy the wings as cheap as possible, essentially, right? Where you don't have to go out, to a 1 delta. You don't have to go out like 500% above and below your short strike, right? You can kind of make it a little bit reasonable. So we just did 15 and 5, right? The whole concept here is short duration, positions, right? And then just frequently readjust those positions around the market. So don't hold positions too long, frequently readjust those positions around the market, okay? Next thing that we did is we did have no VIX filters whatsoever. So it didn't matter where the VIX was. If market volatility was blowing up, maybe like a little bit today where the markets had quite a tough day, right? We had no filter on that. So we just continuously entered positions whenever we had an opportunity. And then when you look here at IV rank, we did deploy just a very small IV rank filter. And what I think is cool about this, doing that little IV rank filter here is that you did have just, kind of like weeding out the low bidders, almost in a sense, where you're just weeding out the really low volatility environments. So what that means is that if IWM's IV rank was a 10 or a 15 or something, maybe for a week or so or a couple days, you wouldn't have entered a position. And that's okay. We were trying to skew it just a little bit towards higher implied volatility, but we didn't set the filter for this particular test to be exactly, 50 or over 50 or whatever. So nothing else there, okay? You'll notice no other entry criteria. We could have added a ton of other stuff here, but we didn't. We left it very clean, very simple, very vanilla, if you will. And the only thing that we really messed with in this particular case study was this right here, which is our profit taking. Now, we did not execute a stop loss for any of these. We exited positions 1 day before expiration. So we took the position off 1 day before. You didn't have to do anything with earnings anyway because it's IWM. So the only thing that we messed with in this particular test as we were kind of modifying things and going back and forth was the profit taking level. So you'll see in this first test number A, which is on the far left-hand column here, this is taking profits at 25%. So really what you're doing is you're taking profits much earlier in the cycle, right? You're taking a smaller profit quickly when you have a small profit and taking the trade off. So again, if you're trading an iron condor and let's say you take in $100 of premium, this would mean that you're taking off the position when the value of that position goes down by 25%. That's your 25% profit. So you would buy back the position at $75, right? You took in $100, you buy it back at $75, you capture the $25 premium as your profit, okay? So that's the only thing that we did. Now, when I click over to the other tests, so if I click and look at the test number B here, you can see I can open this one up and it has all the same criteria, same stuff, except the only thing that I did here in this particular test is I modified the profit-taking level. So in test number B, which is the B column for our comparison here, you can see I modified this to take profits at 50%. And then finally, in test number C, everything was again the same. We tested the exact same parameters, exact same methodology. Everything was exactly the same, except the only thing I messed with here now is I took profits at 75%, which I think is so super fascinating. One is, it's like Goldilocks and the Three Bears here, right? Love iron condor trading. You have your very quick profit taking. You're trying to recycle capital faster, take some premium off, and then you have, everything in between, like halfway with 50. Then you have your 75% profit taking, which is really holding on to the position for quite some time, right? Like you're really trying to squeeze and capture as much premium out of the position as you can possibly get. So without cheating, I mean, like which one did you really think was going to do the best, right? So let me know in the comments real quick. Go ahead in the chat or in the comments or wherever, like which one did you really think was going to be the better performer? I think most people, if you were to really ask them, they would say the 75%. They would say, of course, because just holding on to positions and, letting them ride a little bit longer, that's probably going to be, more profitable, right? And in this case, for total capital return, like return on capital, it was. But I think if we dig in a little bit deeper, I think you find some pretty interesting stuff. I know I do, so that's why I want to share this with you. And since I have the mic here, I can do this and we can go through this, okay? So when you look at the different charts, noticeably you see that test number C was absolutely the best performer when it comes to total return on capital, right? So at the end of the day, test number C had $109 or 109% of total return, right? And you can see it visually. Just the orange line here is test number C. That was the test that had the best return. Now, it also went through some pretty wild fluctuations on the path to getting there, which I think is insanely valuable to look at, which is why you can't, I tell people this all the time, but they still end up doing it. You cannot look at tests in a vacuum, just one metric. Like you can't do it, right? Like one metric does not tell the whole story for performance of a strategy, and certainly wouldn't tell you if that strategy is going to work out, decently well for you or not, right? So when it came to test number C, which again was 75%, taking profits at 75%, look at the max drawdown. I'm going to scroll down just a little bit here so you can see this, but look at the max drawdown for test number C, which was 75% profit taking. You had a max drawdown at any one point of 21%. Now, the key point here is that over the entire testing period was the largest peak to trough drawdown that you had in your P&L. That really doesn't take into account the fact that you could have had, and you did, because you can just visually see it on the chart here, you had multiple times where you went through some pretty nasty drawdowns, right? So here, you went through a pretty good drawdown. Back here, you went through a pretty good drawdown. So the 21% is not that you only went through a 21% drawdown at some point. It's that, if you're going to shoot for that return on capital and you're going to shoot for the higher, premium position and try to capture more premium out of a trade, then noticeably you're going to have potentially a little bit more volatility on the path to getting there, right? Like on the path to getting there. I kind of skimmed over this. I need to talk about this a little bit more because this is really important. But, one of the things that we do, which I think is a little bit different than anybody else I've seen doing backtests, is we have something that helps you also judge capital at risk. And it's not that, capital at risk is, again, the end all be all. What I think is so cool about this is that in all cases, because you were doing a short duration strategy, even though you had a $25,000 account in like the setup of this, and you were throwing that account in there to backtest, you really didn't get above, like a 10% allocation. You really ended up being in one trade at a time. Even though we allowed the system and the bot to backtest a strategy that could be in multiple positions at the same time, you really didn't end up finding that you were cycling through positions where you were stacking too many positions on top of itself. Now, if you run some backtests where you're entering monthly positions, where you're getting into positions 30 days, 60 days out, 90 days out, whatever, you're going to see your total capital at risk start to really fluctuate. And for us at Option Alpha, we're trying to give you just some guideposts on, just like how much fluctuation should I see in my capital? Like how much capital is the bot using as it's, starting to run this test, or how much capital am I using if I start running this strategy manually? Okay. So now let's look at getting back to max drawdown here really quick. So for max drawdown now, if you look at test number A and test number B, you'll notice test number B, it was just so funny. Test number B had a worse drawdown by just a little bit. So like 1%, right? Had a worse drawdown. Test number A had a pretty manageable max drawdown. I mean, honestly, I really think that a 20%, sometimes 25% drawdown in an options trading strategy is probably totally manageable, maybe even should be expected to some degree. But test number A, if this is like a bolt-on strategy where you're not doing your whole account on this and you're doing a portion, right, of your account, then it was pretty manageable. So a 9% drawdown at any one point. Again, you probably had multiple drawdowns for sure. We know, nothing goes up where it's like always up and then it's just one drawdown. So it's a pretty good, strategy taking profits again at 25%. Remember, strategy number A is taking profits at 25%. So initiate the trade and then really quickly get the position off. Where I think it started to show some differences is in the next two lines. So if you look at the next two lines here, which this is your total P&L. So this is total dollar P&L. You look, and strategy number A actually came really, really close to beating out strategy number C. And I think in some periods, it came really, really close. Like right here, like during the big drop in 2020, right? The COVID crash, like it came really close to starting to outperform that. So it's not that taking profits, and this I think is probably the highlight of it for me, was that it's not that taking profits at 25% leads to 25, less money than 75%. I think there's this misconception specifically in trading where if you take profits at 25%, you're going to make a third less money, right? Because you're taking a quarter versus taking 3/4. And it's just not the case here. You obviously you made more money by taking profits at 25% than you did at taking profits at 50%, right? Which is kind of counterintuitive. People don't think about that often. Is like it doesn't really compute until you see the numbers and you see the math that, kind of behind that. And the thing that I think is also really interesting here is also the profit factor. So when you look at the profit factor, which is a really telling one, it's just total profits divided by total losses. So essentially it's like you put $1 in, how much are you going to get back out, right? Like that's really what you're trying to judge on a very crude level and like very fundamental level, right? And so you look at the profit factor wise, strategy A was way better, right? I mean, you really were like risk adjusted wise, like doing much, much better for strategy number A to quickly get the position off and then recycle that capital and enter a new position than you were to try to hold the position longer. It's not that it didn't work. It did. It worked out well. But, from a profit factor, like capital exposure standpoint, you probably did a little bit better with less time in the market, getting that position off quickly, and then readjusting for the next position. So you've got some other ones like your Sharpe and your Sortino and column ratios. Number of positions. So this section is pretty interesting. This was, again, I think a super fascinating one. I geek out over this stuff. So I love like analyzing this and walking through this. I'm sure if you're watching right now, you guys do too. This one was super fascinating. This was all positions in here. So notice total position wise, you trade about the same because you're trading weekly. So you're entering about the same quantity of positions, like total position wise. Win rate, you can see told a very, very significant story. Now I'll pause here on this one and kind of talk through this. When most people set up a 15 delta iron condor, they're traditionally thinking, okay, I have a 15 delta on one side as my short strike. So call it roughly 15% probability of being in the money. And then the other side is 15 delta. So roughly 15% on that side. And you smash those two things together and you should get maybe somewhere around a 70%. Again, like we don't know what exactly is going to happen in the future, but you kind of smash those two things together and you get roughly a 70% probability of success, right? Well, the fact that you took profits on these positions early allows you, and I would say in some cases the luxury of improving your win rate because you're taking profits early, because you don't let it go all the way to expiration where you might have those positions not end up being winners, right? If you take a 25% profit, that position may have been the position that later on ended up becoming a loser, right? So you cut it off early, you chalk up a win, you throw a win in your column, you do pretty well, right? I think that, and this is why I like these for beginners, I like trading on myself, taking these profits early is also a really good way to quickly, get through a trade, not have exposure on too long, and really keep that win rate as high as you can possibly keep it for trades so that you don't have to hold positions all the time and you can kind of, get a better momentum in your account, right? But you can see clearly that when you took profits at 25%, you had a really high win rate on this strategy. It was about 89% win rate. Again, like building the strategy, you're probably at a 70% if you let it go all the way to expiration, probably more because of implied volatility's overpricing anyway. But you take profits earlier, you dramatically improve the win rate just purely by removing the position earlier. When you go at 50%, obviously you improved your win rate to 80. Then you go all the way to 75% because you're holding the position longer. You start to sacrifice, right? This is the trade-off. This is the quintessential trade-off of trading where you're starting to sacrifice positions because you're going to try to hold for bigger profits, which means you might also hold a potential trade that turns around and moves against you and goes the other way. Okay. Is this helpful, by the way? So those of you who are in here now, you guys like going through all this stuff? Okay, good. So wins wise, you notice you had a lot of wins with number A, obviously. Number B kind of in the road. C, you had about 500 wins. Losses, these all tell a very, very simple story. I think what's cool about this one is that your biggest win your best win was about the same across the board. Very fascinating. When you started to really get into it, you started to find that even though you took profits early, your biggest and best win and your worst loss were about the same across the board. So like momentum wise of trading, you might not feel a lot in the first couple hundred trades. And that's really sometimes the struggle with this, which is why I like to do a lot of research on trading and strategies myself. But you might not feel a lot of that because you're not seeing it. So you try one strategy, taking 25%, taking 75%, whatever. You're not really feeling it at the extremes, like the best win and the worst loss, right? Now, streak is where you start to feel it maybe a little bit, your winning streak. And this one was super fascinating for me. I always love looking at streak when I run back tests. Like streak potentially is the number one thing that I look at because I'm just truly fascinated by streaks of positions. But in all of these cases, you had 20 plus winners in a row at any one point. So you probably had it in multiple times where you had a streak maybe of 18 wins in a row or 5 or what, like you probably had multiple like streaks like this, which was, again, I just think super fascinating from, like a study and research side. Mentally, I think this is helpful because it prepares you to not stop trading when you have a long streak of winners. So there's two like thoughts I want to drive home here on this one, right? Number one is don't stop when you have a really good streak of winning trades. I think sometimes we feel like if we have a really good winning streak of trades, like it's too good to be true, right? And maybe some strategies for sure are too good to be true, or some like meme strategies or whatever. Maybe they are, right? But in this case, because we're trading a systematic iron condor strategy, we know we should be winning 80, 90, 85% of the time, right? So it's not uncommon for then us to have a win streak of 10 in a row or 15 trades in a row or whatever. Just don't stop, because at some point you had a win streak of 24, 23 wins in a row. Okay. Now, on that note, just as important as it is for us to look up and like look at all the profits that we can make on a position, let's look down for a moment and just look at the loss streak. This is just as important too. This is interesting for me, and this is why I always look at this potentially as like the first thing that I look at when I backtest a strategy. The loss streak on this trade was 4. Like 3, you could call it 4, right? So it was really 4, 3 for A, maybe, whatever. It was 4, right? Which means that you went through 4 really bad weeks at most, right? Like a bad month. So if you're trading this strategy and you get 4 back-to-back losers, don't give up. You probably had multiple times 3 back-to-back losers, 2 back-to-back losers, but you never had more than 4 back-to-back losers, right? That's really powerful for your psychology because it allows you to like push through those limits when you're trading where you see those things happen, right? And you think to yourself, and I see it all the time where people are like, oh, this trading strategy I just started, I have 5 trades and they're all losers. And I'm like, first of all, you have 5 trades, but like maybe that is like a typical loss streak where you could get into a position. That's why position sizing is so important anyway. But you get into these really interesting streaks, okay? So I thought that was pretty interesting, the loss streak. You get down to the position averages, and we'll kind of go through this one here too. Again, this one was really interesting. Risk-wise, you traded about the same amount of risk for all positions. That's because your account was around the same for most of the time, right? So risk-wise, the number of contracts you're trading, the positions you're trading, like it's all about the same, right? The difference really is the return on risk, right? Which is here. So you can see that strategy number 1 did pretty well. Strategy number 2, which was 50%, kind of was in between, didn't really do that well. And then strategy number 3 was pretty good return on risk-wise, but you also did have those big drawdowns, et cetera, okay? So wins for strategy number 1, which was 25% profit taking, your average win was $138. When you obviously held the position longer, you started to see those average losses or those average win rates go up because you're trying to hold for more profits. So it makes complete sense that you would see that happen, right? And then you get into duration. I skipped right over duration, so let me go back to it. But you get into duration, and this is where you do see quite a bit of difference. Now, as a trader, if I was trading this manually, which I don't trade these manually, I trade all my stuff automated now anyway. But if I was trading this manually, days are like dog years, right? In trading, especially days like today where the market is all over the place because of the Fed, right? So trading is like dog years for days. And so if you're holding a position for a week every single time that you enter a position, you just got to be ready for that. I mean, maybe that's part of your strategy and maybe you want to do that, but I personally would love to hold positions always shorter compared to longer if given the choice. Like all things being equal, I would rather hold positions shorter compared to longer. Personal preference, you may be totally different. Okay. When you were taking profits at 25%, you were in trades about 3.5 days, or sorry, about 4.3 days. That's not too bad. I mean, it's really, you're entering a position, call it 10 days or so out. And then in a couple days, 4 days, you probably hit that profit target. That gives you, again, like a frame of reference for just generally what to expect, right? You're not expecting to hit your profit target the first day, probably not even the second or third day. It's probably the fourth, fifth day. That's when you should start to see enough of that decay come in, and maybe the market didn't move all the way that like to your extremes, obviously. So that's when you should expect to see that profit come in. Likewise, if you're trading this strategy and you're saying to yourself, you know what, I want to trade this, 7.8 day or this strategy, and I want to do the 75% profit target because I just personally like it and I want to go for the higher, win. Okay, great. But now prepare yourself, and that's okay. Prepare yourself. You're going to hold the position significantly longer, right? You're going to hold the position almost double, much deeper into expiration, because you really need the position to get to the point where it's really sucking out all of that potential premium, right? And so you have to hold the position significantly longer in order to make it work, because you're waiting for that higher profit target. Okay. So look, I'm not saying that any of these are necessarily better, worse than another. Some people looking at this, and let me know in the comments, like, do you like A, B, C? Like, you tell me, like, what is the strategy for you? And I know we're going to get people who say A, some people who say, you know what, I like B, some people who say C, right? And this is all like trader preference. This is why it makes it so fun, because we're all not the same. I'm not saying that any of these are what you should do or shouldn't do. It's just really interesting, I think, to compare the exact same strategy run with just even the slightest tweak in how you manage the position, right? I mean, we didn't even get into, like, we can now start doing, and you go into Option Alpha and start, testing different allocations. Okay, well, what about a 10% allocation and 25 profit taking compared to a 5% allocation and 75% profit taking, right? Like, that's the kind of stuff that I think is really interesting. And I hope you guys are doing all the time and, kind of sharing and, going through here and exploring some of this stuff. For me, that's what I like to do. I like to spend a lot of my time going through stuff like this, making comparisons, analyzing different ways of doing it, seeing what the levers are that kind of move the needle, right? Now, once you're done, by the way, if you aren't already inside of Option Alpha, all you can do when you choose your strategy that works best for you is you can actually go in and you can do the one-click create a bot from this strategy. So all of these buttons here, you can just do a one-click. We've got awesome video tutorials that show you, how to get your account connected with your favorite broker and all that stuff. But you can basically build an automated bot. It builds the entire bot using the bot wizard on the back end for you. So it's just literally the exact same strategy that you want here. You just click the button to create the bot, and then you just fill in all the information or confirm it, make any adjustments to it. But you can see it's basically writing the entire decision recipes on the back end and basically putting in all the criteria that you want, right? So it's just preloading this so that you spend your time, and your time is valuable. Spend your time analyzing what you want to do, not trading and doing all the manual, tedious processes, right? So once you're good to go, just go in, analyze the daylights out of everything, backtest everything you want, and then one click, create a bot out of those, make any adjustments you want to it, create that bot, start running it in your account, and you're off and running. Okay. Was this really helpful today to go through this? If you guys did like this, please let me know. Give us a thumbs up on YouTube or Twitter or Facebook, or wherever you're watching this video. Hopefully you guys really enjoy it. But we'll try to do these here a little bit more. Wanted to get this one in here today because I think it was really powerful, especially on days like today where the market's all over the place. It might be good to start executing some sort of shorter duration strategy that is more reactive to different market movements, and you can really kind of quickly readjust these positions. So this was a really cool one I was looking at, and just want to jump on and kind of share what we were doing here. So if you guys enjoyed this, let me know. Again, just help spread the word about what we're doing here at Option Alpha. And until next time,